The greatest investor, certainly of our generation, of our time, Warren Buffett. He's now 90 years old. Can you believe it? So sharp. All right, so he came out, and what's been dubbed the Buffett Indicator, the single greatest measure of future stock market performance or stock market valuations, is what he said 20 years ago, now has a warning for us. I'm going to tell you what that means coming up. Hey, my name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, Warren Buffett, 90 years old, but my goodness, he is brilliant. Brilliant investor. He owns Berkshire Hathaway, right? Started that, but he's just an investor. So he is a value investor, and he's a most famous student of Benjamin Graham. And so he's just made a gazillion dollars. And about 20 years ago, he went on record. Now, obviously, he loves the stock market, believes in the long-term potential of the stock market, investing in the world's greatest enterprises. But he said 20 years ago, the single greatest measure of whether the stock market is high or low is a comparison of the overall total stock market cap compared to the country's GDP. And when the total market cap begins to exceed 100% of our GDP, then watch out. That's a warning that stocks are beginning to get overvalued, overpriced. And as a value investor, like I said, he's looking for the best companies, the best enterprises, and he wants to buy them at good discounts. So he's a student of Benjamin Graham. If you've never read The Intelligent Investor, it's a wonderful book. It's 700 and some pages. But basically, Benjamin Graham, back 100 and some years ago, said every single day you go to Mr. Market. And sometimes Mr. Market is asking a lot for his investments. Sometimes Mr. Market is willing to sell you his investments at a discount. And you need to know what you're looking for, what good investments are, and buy a lot at a discount and be willing to sell when Mr. Market it thinks they're worth this much. And so this Buffett Indicator, overall stock market cap compared to GDP as a percentage of GDP, our country's GDP, is what Warren Buffett says is the greatest measure of whether stocks are too expensive or not. If you go here, now this is just a generic website, Guru Focus. I'm not pushing them, but it's a very quick and dirty way for you to tune into that Buffett Indicator and say, well, hey, how's this thing doing? And if you look right now, you will see it right there in red, significantly overvalued. The stock market, according to the Buffett Indicator, isn't overvalued, it's significantly overvalued. So to me, that is a warning. This is saying the stock market is currently at 187% of GDP, which would suggest a potential one-year return from this point forward of a negative number, and that includes dividends. So that's a warning sign. I would take that one-year estimate, that one-year return target, and completely throw it out the window. There is absolute randomness of one-year returns. And I've got all the data that I can show you on that. No one knows where in the world the stock market will be 1 year from now. And if you look at all the data to say if the stock market has a high P, low P, or whatever, it's completely random. Okay, so that 1 year return, I would tell you, throw that out the window. But the premise that the U.S. stocks are significantly overvalued, I think I would agree with that. Now, let me add a little bit more to it. When you look at total stock market cap, total market cap compared to global GDP, folks, we've just entered the danger zone as well. Global market cap compared to global GDP now surpassed that 100% threshold as well. So not only are U.S. stocks potentially significantly overvalued, but you also have global stocks, which international stocks have underperformed, emerging markets have underperformed. But when you look at the total global market cap compared to total global GDP, we've now entered the danger zone, folks. And then thirdly, before I apply, the other way that I look at, and many investors look at to see, well, is the stock market appropriately priced, too expensive, too cheap, or very cheap? We tend to look at forward price to earnings ratio. And I've taught what the price to earnings ratio is on this channel before, so check out that video if you've missed it. But essentially, the last time I talked about this was probably a month and a half ago, and I told you, watch out, this PE ratio, the price of stocks compared to the earnings of those companies, we're now at a dangerous level. It hasn't been this high since 2001, a time famously known as the tech bubble, right? Guys, it just continues to go higher. We are now at PE levels that we haven't seen since 2000. And the peak was 99, early 2000s. We're not quite there yet. Pretty much everyone is saying there's no way we'll get to that level. We'll never see that global forward PE at that level again, but we are dangerously close. And I guess I would just want to introduce again to you that the last time stocks were this expensive was during a time that has a reputation unanimously called a bubble, okay? So watch out, you could be playing with fire. There's one difference. There's one difference. And the difference is Robinhood. No, I'm just kidding. The difference is Fed stimulus. Well, no, that's actually kind of true, a couple $1 trillion. No, the difference is back in March of 2000, the 10-year Treasury, so bonds, were paying 6.2%. Today, they're paying 0.6. That is an enormous, that little move of the decimal point, that is an enormous change. So where else are you going to put your money? And it's very, very possible people, investors, are willing to take on more risk today for future returns because you can't find returns anywhere else. I think that is very logical. I think that's quite appropriate, but I also think it does increase risk and does actually still concern me. So I understand it. It's just, how high can this stock market go? How detached can the market get from the expected earnings before we would say, well, what were we thinking? Before we say, okay, that was extreme. I understand investors are willing to take on more risk because you can't find return anywhere else. However, we are in the danger zone, folks. So what does this mean for you? Make sure you've got a prudent investment philosophy that hopefully can capture upside when momentum is moving in your favor, when risk is moving in your favor, and protect on the downside if that pivots very, very quickly. Because it does seem like at some point we're going to look back on this time and say, yeah, what were we thinking? Things weren't actually different this time. Right? Back then it was, things are different this time. We've got the new economy. We've got the information economy. We've got computers and the website. The internet is just going to change everything. And right now we're saying, and of course, that turned out, we said, no, we were foolish. Now we're saying interest rates are zero. You can't get return anywhere else. So of course, this is different this time. Interest rates are zero. We've got to be plowing into stocks. My guess is inevitably we'll look back on this time and say, yeah, no, things got a little too hot. So do you risk it? Do you just go all in? Do you go all out? No, you need to have a prudent investment approach that fits with your entire financial situation. Work with your CFP to make sure you're taking the right level of risk, you have the right strategies, and you're taking the right approach for your overall financial plan. If you don't have a CFP in your life, you can always contact a member of our team. Find us online, corehorn.com or wisemoneyshow.com, or you can always give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.